Professional Wall Street traders work 60 to 80 hours a week to try to beat the S&P 500, and over any substantial period of time, over 90% of them fail. So, knowing that the S&P 500 is pretty much the best place to invest and has been for pretty much forever, we wanted to make a video clearing up the common question of which S&P 500 fund should we invest in. There are 20 to 30 different funds out there that all track the same index, the S&P 500, and so it can get pretty confusing. So, we've compiled 8 of the best ones for you in this video. Please comment down below which one you invest in and which one you think is the best. Welcome to Master Wealth, where we try to make investing simplified. So, the S&P 500 is the actual index. The S&P 500 index features 500 leading U.S. publicly traded companies with a primary emphasis on market capitalization. The S&P 500 index was launched in 1957 by the credit rating agency Standard & Poor's. You can't directly invest in the S&P 500 because it's an index, but you can invest in one of the many funds that use it as a benchmark, tracking its composition and performance. This is why we use ETFs or mutual funds to actually invest in the S&P 500. These different S&P 500 index funds will be nearly identical to one another in terms of their performance and their holdings or the particular stocks held within the fund. Investing in multiple S&P 500 tracking ETFs or mutual funds is not going to further diversify your portfolio, so it's best to just pick one. Depending on the fund, some index funds or mutual funds or even ETFs are going to invest in a portion of their funds in the S&P 500. So, make sure and check how the fund is actually built up. Just because it says it has S&P 500 in the name doesn't necessarily mean that it's tracking just the S&P 500 itself. So, how should we pick the right fund for you? While most S&P index funds will have similar holdings, they may vary in terms of their fees, such as expense ratios. Expense ratios are annual fees you pay to help cover a fund's expenses. If you invest in a fund with a 0.25% expense ratio, you'll pay $2.50 annually for every $1,000 invested. That may not sound like much, but if your account balance grows, so will that fee. Consider looking for S&P 500 index funds with low expense ratios, several years of operation, and a healthy amount of assets under management. The longer the fund has existed, the more information you have about its performance history. In all the videos that we do on this channel, we definitely try to show you ETFs and picks that have a long history because we want to see how a fund has done not only during good times, but also bad times. We also want to see that if it's a bad time now, over the last year, how did it do during the good times 10 years ago, 15, 20 years ago? The reason why we want to have a fund that does have high assets under management or net assets is that it should be a little more stable when markets are a little volatile. Usually, funds that have fewer assets are going to be volatile with the market, and that's not what we want when we're investing. So, what about this whole idea of ETF versus index fund? Because in this list that we compiled, it does have some ETFs and also mutual funds. The biggest difference between ETFs and mutual funds is that ETFs can be traded throughout the day, whereas the mutual fund or index fund can only be bought and sold at whatever that price is figured out at the end of the day. If you're investing for the long term, meaning you're buying and holding the funds for 5 years or more, this difference won't matter much. But ETFs are generally more tax efficient than index funds. So here's the list for you, and at the end, we're gonna tell you which one is our favorite, which one we think is the best, but we're gonna give you some pros and some cons, if there are any, for all of these, so that you can make the best decision for you. The first one on the list is one of the most popular ETFs in the whole world, and it's one we like very much, and that we talk about on this channel. That's the Vanguard S&P 500 ETF, or VOO. We get this question a lot as to why we always talk about VOO versus some of these other ones that actually have a little bit better of a price point and have a lower expense ratio. The reason why we do that is because with VOO, you can buy that on pretty much any investing platform. And we're trying to make content for you, and we don't know exactly what you're investing with. There's going to be some mutual funds that we talk about that are super awesome, but if you don't have that account with that company, you're not going to be able to invest in that mutual fund. Anyway, VOO is one of the favorites by far. Its return last year was 26.32%. It has an expense ratio of 0.03%. The dividend yield is 1.43%. The assets under management are 980 billion, so it's huge. This ETF has been around since September 7th, 2010, and once again, it's one of our favorites coming out of Vanguard for the investing community. The next one is SPY, and this is the SPDR S&P 500 ETF Trust. SPY is an ETF, not a mutual fund, and it's not even the lowest cost S&P 500 ETF. It is, however, the most liquid S&P 500 fund. Liquidity indicates how easy it'll be to trade an ETF, with higher liquidity generally meaning lower trading costs. Trading costs are not a big concern to people who want to hold ETFs long term, but if you're interested in trading ETFs frequently, then it's important to look for high liquidity funds to minimize trading costs. For those of you that are just trying to buy and hold forever, this doesn't really matter to you. SPY has an expense ratio of 0.09%. Last year, it had a return of 26.19%. The dividend yield is 1.42%. Its assets under management are 481 billion, and the inception date was January 22nd, 1993. SPY is definitely one of the most popular ways to invest in the S&P 500. The next one in this list is a big one, and it's one called IVV, and that's the iShares Core S&P 500 ETF. The iShares Core S&P 500 ETF is the second largest exchange-traded fund in the US in terms of net assets after SPY. IVV charges an annual expense ratio of only 0.03%. That means you pay only $3 in every $10,000 invested, roughly one-third of the annual cost of SPY. But for active traders, IVV is at a disadvantage with an average daily volume of about 4.4 million shares over the last 3 months. IVV offers a fraction of the liquidity of SPY. It had a 2023 return of 26.32%. The dividend yield is 1.47%. Its assets under management are 414 billion, and the inception date was May 15, 2000. IVV gives you the size of SPY, but without that huge cost in the expense ratio. The next one on the list has the lowest expense ratio so far and has the lowest share price. So, for those of you that want to buy in and a little bit cheaper and you don't have the option of being able to do fractional shares wherever you're investing, this one is a very solid option. If you want to invest in the S&P 500 but don't want to spend $450 per share like VOO, SPLG is at about $55 per share instead. SPLG is the SPDR portfolio S&P 500 ETF. This one has a super low expense ratio of 0.02%. It had a return last year of 26.24%. The dividend yield here is 1.4%. Its net assets are 27 billion, and the inception date was November 8, 2005. If you notice, this is the second S&P 500 fund from SPDR. Why in the world would they have one fund that tracks the S&P 500 and another one that tracks the S&P 500, but it's just cheaper and has a lower expense ratio. Basically for that reason, to compete on cost. Very similar to how Invesco has QQQ and then just came out with QQQM as the cheaper alternative, but invests in the same thing. The next one that we're going to talk about on this list is a mutual fund, and this one is the Vanguard 500 Index Fund Admiral Shares, VFIAX. Vanguard was the original index fund and still has the largest assets under management, with about $980 billion worth of net assets. It has an expense ratio of 0.04%. The 2023 return was 26.24%. It does have a minimum investment of $3,000, and the inception date was November 13th, 2000. Anything Vanguard is just going to be very solid, very low fee, and it's such a huge company that it's pretty safe to be holding your money and your investments within that area. The next one comes from Charles Schwab, and it's again another mutual fund. This is the Schwab S&P 500 Index Fund, SWPPX. Schwab's S&P 500 Index Fund seeks to track the total return of the S&P 500 index. The fund generally invests at least 80% of its net assets in these stocks. The actual percentage is typically considerably higher. It generally will seek to replicate the performance of the index by giving the same weight to a given stock as the index does. This mutual fund is half as expensive as buying in from Vanguard though. This one has an expense ratio of only 0.02%. The 2023 return was 26.25%. The assets under management here are $82 billion. It doesn't have a minimum investment, and the inception date was May 19th, 1997. The next one on this list comes from Fidelity, and it's one that we know a lot of investors really like because it gets placed next to VU all the time. Although it is not an ETF but an index fund, and we can see why. It's a very solid fund. This one is the Fidelity 500 Index Fund, FXAIX. This one is one of the lowest out there in terms of fees, and then the other after this is going to be even lower. The expense ratio on this is 0.015%. The 2023 return is 26.29%, which is the highest of these mutual funds. Fidelity has assets of $472 billion. It doesn't have a minimum investment, and the inception date was February 17, 1988. This next one on the list is even cheaper than FXAIX and SWPPX, as it literally has zero fees. Zero. FNILX is Fidelity's large cap index fund, so it's almost entirely composed of companies with market values over $10 billion. It tracks alongside 80% of the companies in the Fidelity US Large Cap Index, and many companies on which it's meant to mirror the performance of large cap stocks. Like we said before, the expense ratio is literally 0%. The 2023 return is 27.45%, which is the highest out of anything on this list. The dividend yield is 1.34%. The assets under management are only $7.61 billion, and it doesn't have a minimum investment. Its inception date was fairly recent, on September 13th, 2008. Now remember, this fund is tracking the US Large Cap Index, whereas all the other funds were actually tracking the S&P 500. Now, companies within the S&P 500 are going to be large cap, but there is just a little minor difference between the two. Long term, FXAIX has posted a little bit better returns, but this FNILX is completely fee-free. As mentioned earlier, FNILX is a zero-cost mutual fund. It's part of Fidelity's series of zero funds, and they really mean zero. There's a 0% expense ratio, no service or distribution fees, and no minimum investment to get started. And now, which one do we think is the best? Honestly, every single option in this list is a very viable option. and we would be super happy if we saw one of these in your portfolio. We would say, good job. In relation to Charles Schwab, we think SWPPX is one of the best ways to invest in the S&P 500, as it has the cheapest fee and has a super solid return. But overall in this list, our favorite is definitely VU because of its size, its reliability, its very low fee, and the fact that you can have access to investing it on pretty much any investing platform. Well, that's all for this video. Remember, financial freedom starts with an adaptable mindset. See you in the next video. Cheers!